What is the average return that we can expect from any mutual fund?
You asked average return.
Correct.
Okay. Before answering these questions, I would like to explain few terminology which is more important to understand the kind of return mutual fund generate. First, we have to understand the unit of return. I mean, how the return is measured. Okay. If you have invested X amount of money on a particular year, and after 5 years, suppose you are taking out that money, the return what you generate, one is absolute return. Suppose you have invested at 100 rupees and after 5 years it has become 200 rupees, for example. So you have got 100 rupees in 5 years.
As absolute return.
So 100 rupees become 200 rupees.
Right.
So the return of 100 rupees is an absolute return in 5 years.
Right.
But that is not the return which is comparable with other assets.
Okay.
How do you compare? So you have to break it. That per year how much you want. Okay. So in a 5-year period, suppose you are making, for example, 100 rupees, then per year how much you made is what we call is CAGR, compounded annual growth rate. Okay. So the return has to be broken, or return has to be looked in the its unit of CAGR.
Okay.
Like liquid we measure in liter, or solid we measure in kg, or there are various measurements for different things. For any kind of return you have to measure it in CAGR.
Okay.
That is compounded annual growth rate. Say common investor or young investors don't understand this CAGR. So you have to understand that CAGR. It is very easy. If you Google it, you will have the answer how the CAGR is calculated. Okay. Then what happens? The people invest and people take out money, and again they invest and again they take out money. So then it has to be also calculated in that fashion ki how much money remained as an investment in how much period. So to exactly calculate that from an investor's perspective, we have to calculate the IRR and XIRR. Okay. So first we have to understand this CAGR, IRR and XIRR. Okay. So that concept you need to clear. I mean, it's very easy. You just Google it, and there are empty number of nice videos which will explain what is CAGR, what is IRR and XIRR. So you need to look all your investment with that perspective. Then you will have a clearer idea.
Okay.
So like I was telling, there is a point-to-point return from one point to another point. Then there is a CAGR and there is a IRR and XIRR. There is a concept called rolling return. To measure any financial product, how that financial product is giving you the return. As a investor, I must also know what is the rolling return of that particular financial product. If I say equity and I take equity index as a unit of investments, so then I have to see in the last 20 years what is my 3-year rolling return.
Okay.
So every 3 years in the last 20 years, what kind of return this product has given me. So that's called a rolling return. Okay. Or in last 20 years, every single year investment will give me a result. Right. So if I have a 20-year period, I invest in say 2000, then I disinvest at 2001. I invest in 2001, I disinvest in 2002. I invest in 2002, I disinvest in 2003. Like that, you will have a sequence of rolling return, 1 year period. Similarly, I can change it to 3 years. I mean, I stay invested for 3 years.
Okay.
Similarly, I can change it to 5 years.
Right.
I stay invested for 5 years. Then what is the result? If I take all these, so then that is called a rolling return analysis. Okay. So when you ask me what is the normal return for mutual fund, I can tell you about what is the average rolling return, per year rolling return, 3-year rolling return, 5-year rolling return, like that. For simplicity, let us talk about index. The long duration, if you see the rolling return of say 5-year, 10-year, 15-year period, where normally I always say, you should invest from one investment cycle to investment cycle, that is 7-8 years. So if you take the rolling return of 7-8 years of the index,
right,
it will be something like 11.5 to 12%. Okay. That is the historical data. How it is going to perform in the next 10 years or next 20 years, we don't know. There are various variables like GDP growth, inflation, interest rate. Those are the variables which is required to know, or how they are going to shape up will affect the return. But in an average, considering the normal circumstances, say your inflation remain say 6%, or your interest rate remain at 7%, or GDP growth stay at say 7%, something like that, then you can have similar kind of result. Because in the last 20 years, these were the averages. So you will have a index return of say 12%. That is index without considering the dividend yield.
On a yearly basis.
If you add the dividend yield of say 1 to 1.5%, so that means it will be a 13%. For example. Okay, so that's the kind of a return you can expect from equity fund. Okay. Then in equity itself, as I explained, there are different type of equity fund. So last 10 years, your average index have given a very low return. But if you see the IT index or the IT sectoral fund or pharmaceutical sectoral fund or consumer sectoral fund, they have given return as high as 20% compounding for last 10 years. Okay. If you talk about infrastructure or realty or real estate fund, they have not even crossed 10%.
Right.
Why? Because these are a sectoral fund. Okay. So when you talk about the return, we are just talking about the index or generally diversified fund. A generally diversified fund will something give, index will give say 13%, mutual fund diversified scheme will give say 15%. Okay. But these are the things which has happened in the past. Future will have a different result depending on the, as I said, inflation, interest rate, GDP growth, etc.
In that manner, even large cap mutual funds or mid cap or small cap would have different percentage of returns, right?
Exactly. If the small cap will do very well in the next 10 years, then we will have a very good return. Okay. Mid cap will do, for that matter, will do very well in the next 5 year, 10 year. It will have a different kind of return.
So this is
you cannot generalize, but it varies from 10 to 15, 20%. Sectoral fund can go as high as 20%,
right,
or a pure diversified will be 10 to 11%. Right. And a mixture of this, how well you do a portfolio construction, taking into consideration of diversified, sectoral, gold, debt, all put together, you will get something like average of all this.
Right.
And that is what we aspire to do, and that is much higher than your basic inflation and fixed income return. So as long as this gives you a fairly higher return than the fixed income and inflation, we should be happy.